So you're in business and don't quite understand what your profit and loss account is? Follow my video and I'll explain all. If you haven't yet, click the bell and subscribe to be notified every time we produce our best pieces of content. One of the key statements as a business owner is a profit and loss account. This tells you ultimately whether you are winning or losing profitably. So follow my video and I'll explain what's included in a profit and loss account and why it's important for you, the small business owner. What is a profit and loss account used for? To start with, it forms part of your financial statements that you could be preparing for your limited company. But you will also prepare a profit and loss account if you're a sole trader, partnership or LLP, which is known as a limited liability partnership. Now, a profit and loss account tells you how well you're doing. So as the same with a sporting event, say NFL or football, you have a scoreboard to see how well you're doing. That is what a profit and loss account is for your business. It tells you for the year whether you are making a profit or a loss. So within your profit and loss account, and I'm going to dumb this down in layman's terms, it is income less costs equals profit. Now that profit will be taxable, whether that's on your self-assessment, or it's on your partnership return, or on your CT 600, which is the tax returns that companies prepare. You will then have your tax come off, and then you'll have available for distribution, which could be either drawings by a sole trader or dividends by the shareholders of the company. But your profit and loss account tells you exactly how well you are doing. Now, when you prepare these, they're in a bit more detail. So what you tend to find is you'll have your income from your main trade. So your trade could be construction, it could be an estate agent, or it could be someone like us, an accountant. So this will be in your profit and loss account. All of your income and your costs will be excluding VAT if you are VAT registered. If you're not a VAT registered business or you're exempt, all of your costs in your profit and loss account will be gross including VAT because you haven't claimed the VAT back. Really important to notice that because it's easy for business owners to presume incorrectly, which I'm sure you're not doing. For your costs are normally categorized in a few different ways. The first one is cost of sales. Cost of sales are expenses that directly relate to you earning that income. So I'll give you an example. A construction business, materials, subcontractors, labor, anyone working directly on the construction job for them to be able to complete it will be a cost of sale. For an accountancy business like mine, it would be my team members that are physically working on client stuff will go down as a cost of sale. If you've got an estate agent, it will be the people out there selling, doing valuations, but it's everything that you can directly relate to you making the product or service that you deliver. That's known as cost of sales. So what tends to happen on a profit and loss account is you'll have sales, less cost of sales equals gross profit. This is normally a key margin that people like to look at because you would look at your gross profit percentage to see how much you've earned compared to how much you've spent. And there's normally good benchmarks with industries to see, oh, is that a good margin that we're making on this? Or is it not? The second lot of expenses that are sometimes classified are selling costs. And these are items that you're using to spend on to get future income. So this could be pay-per-click advertising, this could be salespeople, this could be events. So it's easy. I quite like having selling costs on the profit and loss account because normally what this shows to me is how much the business owner is investing in the future. So within your business, as we sit here in a minute, how much are you investing within selling costs that are allowing you to grow your business further? Or are you just taking the bare minimum and waiting to see if business comes to you? I think it's important to really get a handle on this figure. The next cost that will be separated will be administration costs. So these are known as overheads. So you can't directly relate these to the business. These are overheads that you spend where the business just runs. So these could be support office costs, these could be admin team, this could be insurance, it could be a whole manner of things that you can't directly relate to a job. Bona fide genuine business expenses, but they support the business. What you tend to find is a lot of these costs are fixed or stepped. A fixed cost is where it doesn't change with income and it stays fairly static until you get to a level of where you have to upgrade, and then it stays to another level of fixed cost, which is known as a step cost. So what you tend to find is these overheads support the business. So what you want to be able to make a profit is your gross profit less your selling cost less your admin expenses equals your profit before tax. Ideally, every single business owner wants to be aiming for a profit. Sometimes this doesn't happen, especially with startups and growing businesses, but you want to make sure that you are maximizing your profit to as much as possible. Now, your profit is going to lead into one thing that a lot of people don't like paying but have to accept is tax. So your tax is a direct reflection of how much profit you're earning. So within a profit and loss account, HMRC will see a copy of your profit and loss account to see whether it looks in line. And now it's not a review. They've got various computer systems that use algorithms to check these. So with regards to your profit before tax, which is sometimes known as net profit, what net profit are you earning before your business? And is it in line with your industry, and could it be better? Because in the UK, a lot of small business owners will take a combination of salary and dividends. You want to make sure that you have available money, profits within your company to be able to pay these dividends. Otherwise, you can't get your three numbers. And if you want to know what the three numbers are, follow my video here. I talk about the three numbers that you need, which is your safety number, your nice to earn number, and your wow number. And you want to be achieving this within your business so you can actually live the life that you want to. And don't forget, this should be after personal tax as well at the same time. So what you've got within your profit and loss account, you're looking at sales less cost of sales equals gross profit. Gross profit less selling costs, less overheads equals net profit before tax. You then take out your tax and you take out for your dividends to see how much available profit you've left in the business. This can be important for lots of reasons. One, if you're looking at financing your business where you're growing and you're using loans and to be able to scale your business, the lending company will want to make sure that you're not ripping all of the profit out of the company and you're leaving money in there where you're reinvesting back into the business. They could call this a lifestyle business. And what's even more important is if you have taken all the profit out of your business, make sure that you don't have a whopping overdrawn director's loan account. Now, if you're not sure what a director's loan account is, follow my video. I talk exactly what a director's loan account is, how they're made up, and I give you all of the information that will help you understand this area. Now, an easy way to produce a profit and loss account will be on your cloud accounting software. Now, make sure with your cloud accounting software that the records are up to date, because what you need to make sure is all of your transactions are on there and they're reconciled for the profit and loss account to be meaningful. But instead of doing an exercise where you would have to get an old-fashioned quill or an Excel spreadsheet, you should be able to get a decent profit and loss account from your cloud accounting system as long as this is reconciled. So do you have that system currently in place within your business, and how often are you reviewing your own profit and loss account? A profit and loss account is how well you're doing. It's your scoreboard for a given amount of time. Do not get confused this with a balance sheet. Another main statement that form a good part of your financial statements is your balance sheet. A balance sheet is a picture at any given time of all your assets and liabilities. Don't get this confused, although it's easily sometimes possible. So make sure as a business owner, you've got a handle and a good understanding of what the difference is between a profit and loss account and a balance sheet. Now, I hope this video's really helped you, but if it's spurred any questions that I can help with, please click my Calendly link below. I promise that I'll answer all of your questions, get to know you a bit, and I promise there'll be no pushy sales pitch.